Stepping back and looking at the options for an investor, investing in credit versus equity these days. Obviously, you have funds that do both of these things. And so you've got a little bit of a bias here. But if you were an objective investor, which one are you more excited about right now? Which one seems more attractive to you right now from an investment perspective?
It's hard to not love credit today. The risk today, I mean, we all know it's a more volatile market today than it's been in a while with the interest rate environment and what that's caused in the banking sector and so forth. And we also own a bank as well, and actually buying another bank right now. And so we know the banking side really, really well. But the credit side's hard not to like. Given, because of the increase in interest rates and because of the lack of traditional financing that's out there from banks, the ability to get double-digit yields in a credit position with very little volatility, cash flow immediately, not a lot of risk. If you're investing with a good lender who knows how to manage credit risk effectively, it's hard not to like. And the saying that I've heard for a long time is the smart money is on the credit side. It's sexier, it's more fun, there's bigger upside being on the equity side. It's exciting owning something. But being on the lending side, we get the majority of the upside with a lot less downside. But I'd also comment that our equity funds are I would consider it more of a mix between debt and equity because there's always subordinate equity to us that shelters. I'll give you an example right now. It's not one I love in the respect that I'm not happy about this for some investors. So we have a deal right now in Texas where we have about a $15 million equity investment into a really nice apartment community. But due to some of the challenges with the interest rate environment, we did the deal as pref equity with a sponsor, so with a syndicator, a sponsor who went out and raised money into the deal. So we put $15 million in, our money in first, our money ahead of the sponsor's equity. Well, the sponsor raised $5 million of equity from individual investors, probably some doctors, and their equity is sitting behind the lender and behind our $15 million. Our $15 million gets all the cash flow first. We get all our $15 million back plus a 17 or an 18% IRR, return on our money, before the sponsor and his investor gets any money back. And long story short, right now, unfortunately, the investors who invested directly with that sponsor, they're going to have all of their money wiped out. They're going to walk away with $0. So they're not going to have gotten any return and lose all of their investment, while our investors are going to end up with a 17 or an 18% return. So that's an example of being where you sit in the capital stack is really, really important. And sitting in the lender position is almost always the lowest risk position, but sitting ahead of the top of the common equity, which is how we invest, ahead of that common equity, reduces our risk and increases the consistency of our returns.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.